Hi, and welcome back to Unit 13 of BSS 310, which is all about setting the MAR. In today's unit, we're going to differentiate between debt and equity financing for a project. We're also going to calculate the weighted average cost of capital. Then we'll discuss the factors that influence the setting of the MAR, and I'll show you how to set a MAR for your project. But let's first talk about this acronym called the MAR. MAR stands for Minimum Acceptable Rate of Return, or in some cases people even talk about the Minimum Attractive Rate of Return. There's also another phrase that's often used in industry, namely the hurdle rate. Wikipedia has the following definition about the MAR, or the hurdle rate. It is the minimum rate of return on a project that a manager or company is willing to accept before starting a project, given its risks and the opportunity cost of foregoing other projects. The hurdle rate is a really neat synonym for the MAR because it explains exactly what this percentage does for your company. Let's look at those four ladies in the picture. Imagine that each one of them is a project with its own costs and anticipated benefits. Those four ladies now have to see whether they can jump over that hurdle. If they can jump over the hurdle, they'll be considered financially feasible for our company. The athlete is the project's cash flow, and the hurdle itself is the MAR. We as a company get to set the height of the hurdle. If a project cash flow can jump over the hurdle, it is financially feasible. Now, how do we determine how high the hurdle should be for our company? That is what we're discussing today in Unit 13. How we determine whether project cash flow has jumped over the hurdle or not is dealt with in Unit 14. So let's rewind a little bit and talk first about the capital budgeting process. A formal definition for the capital budgeting process says that it's the process of allocating a company's financial resources to long-term investments with the aim of maximizing the company's value to its shareholders. The informal definition might be a little bit more palatable. Capital budgeting process is the process of deciding which business projects to invest in to make the most money, which is immediate financial goals, while positioning the business for further future success, which talks about strategic alignment. So in the formal definition, when they talk about value to its shareholders, it combines both the concept of immediate financial goals and strategic alignment so that the company can continue being profitable in the long-term future. Here is one of many depictions of the capital budgeting process. First, we start off by developing proposals. So we come up with alternative ideas for alternative projects or product lines that we can offer to the public to make money. Once we have a set of proposals on the table, we'll first put it through what we call a strategic alignment filter. Why do we do that? Well, let's imagine that we're a car manufacturer, and suddenly we notice a gap in the market for making chocolate-covered donuts. The proposition to make chocolate-covered donuts might be really good, and we could make a lot of money, but it doesn't align with our strategy of making high-quality automobiles. And so why would we pursue such a project in the first place if it would require that we reframe our entire business, which might make us money in the short term, but it may cost us a lot more in the long term? That's a pretty extreme example. Let's think about something else. Let's imagine that I'm a company developing certain products in South Africa. I have now identified Malaysia as a fast-growing market for my product. In the board meeting, two proposals are put on the table. One is to pursue a project that would take us to Norway so that we can establish a market presence in Norway. And one will be a project that can take us into Malaysia to establish a market presence in Malaysia. I've already determined that I want to move my company towards Malaysia because in the long term, I foresee that it would be more profitable for my business to have a presence there. So that makes the project in Norway misaligned with my strategy because even though I make money in the short term, it's not my long-term strategy to be in Norway or to have a presence in Norway. So that strategic alignment filter is almost like a first cut for proposals to make sure that what we put our energy into aligns with our strategy for our business. Once I now have a pool of projects that strategically align with my business goals, I can estimate the cash flows. Once I have a set of cash flows, I can do a risk analysis to determine how certain I am about those cash flows. And then I can move over to analyzing the cash flows, so determining whether my project cash flows jump over my hurdle. So what we're discussing today, the setting of the MAR, is somewhere in between these two blocks, risk analysis and analyzing cash flows. Because once I have my MAR, I can analyze my cash flows, and then I can apply my economic feasibility criteria, which we'll discuss in Unit 14, to determine which projects are economically feasible. It might happen that more than one project is economically feasible. So, in other words, more than one lady jumped over that hurdle. But I might not be able to pursue all of those projects immediately, so I need some way to rank projects. Once I've ranked projects, I can decide how I want to finance them. Now, this is a bit of an iterative step, as you'll see later in today's lecture, because we need to know something about our financing structure here when we calculate our MAR. But at the same time, we're only going to actually do the financing once we've committed to certain projects. Finally, there's an ongoing task called portfolio management. Once we've embarked on a couple of projects, we've gotten the financing and the projects have started, we need to constantly be re-evaluating new proposals and bringing them into the stream. This is an overview of the capital budgeting process. For BSS 310, we'll be focusing on the step over here when we calculate the MAR after we've estimated cash flows and done a risk analysis. And in Unit 14, we'll look at how we analyze the cash flows to decide whether a certain project is economically feasible. What is capital? Every project requires a certain amount of capital, or let's think about that as setup costs or investment costs up front. This capital is comprised of debt and equity financing. It could be all equity financing, it could be all debt financing, or any combination of the two. So what is debt and what is equity? Debt, quite simply, is outsiders' money. So the money of people that are outside of the business, that are not owners in the business. Equity is owners' money. So people that have shares in this business. Let's look first at debt. Typical forms of debt that you might have heard of are loans and mortgages. A mortgage is merely a loan that has a specific building or facilities as security for that loan. If you think about credit card debt, vehicle financing plans, mortgages on homes or facilities, those are all forms of loans. Bonds are another source of outsiders' money that companies can use when they need capital. Now, some of you may not have heard about bonds before, at least not as a financial instrument. So what I suggest is that you watch this quick little clip as background to what a bond is. When we use outsiders' money, the payment terms are set. So when you have taken out a loan with a financial institution or you've issued bonds to the public, your payment terms are set. You know when you owe which types of payments. And if your project is massively profitable and you make millions of rands in profit, the public who hold your bonds or the financial institutions who lent you money don't have any claim in the profits. They only have claim to the payment terms which were set up front. But debt funding is much more riskier than equity funding. Let's imagine that your project didn't go so well and your company is actually liquidated. Your creditors, so the people that lent you money, which could be a financial institution or the public, are standing in line waiting to get some share of your assets that have been liquidated. So even when your business folds, you still have some sort of a responsibility to your creditors, the outsiders who have lent you money. Let's consider equity. Equity is money which belonged to your shareholders in the first place, so the owners of your business. So when we buy shares in a company, which is called stocks in American terms, we're basically buying a little bit of the ownership of that company. So when a company lists on the JSE and issues shares, they're actually diluting their ownership into very, very small pieces and selling those small pieces of ownership to the public. They, in exchange, get capital for that little bit of ownership. When you are a shareholder, you have a claim in the profit because obviously the better the company does, the higher the value of your shares, and if a company makes large profits, that could flow to you in the form of dividends. But if the company makes losses, you don't have a claim. So if you're a shareholder and the company does really badly, your shares will be devalued and you won't be paid dividends. Another form of owner's money that we can use is retained earnings. If a company made a large profit the previous year and paid out their dividends and after all of that still had an amount left in the bank, they could decide to keep that over for the next year as retained earnings. That then becomes capital that they can use in future projects. But even retained earnings doesn't come without a cost. I quickly want to just move back to the whole concept of bonds. Most likely, if you have heard of bonds as financial instruments, it's been in the movies, most likely in an American context. So you may know that there's something called a government bond, which is bonds that the US government sells to raise money from the public. South Africa does exactly the same thing. In fact, every single government on earth issues bonds, governmental bonds, to the public and on stock exchanges worldwide if they can. How do you determine the value of a bond? Surely something about the country's economy and the prospects of the country to do well in the long term has to play in on the return that you expect from a bond. Now, here's a little bit of a tangent. You may have been aware that recently South Africa was downgraded by Moody's to junk status. If you have no idea what I'm saying, just go Google South Africa downgrade or Moody's downgrade, and it should give you a couple of articles to explain to you what the meaning of a country's credit rating is. Now that Moody's was the last of a couple rating agencies who have downgraded us to junk status, South Africa as a country is seen as a junk status country. That means that we are a lot more riskier to invest in. That means that our governmental bonds are also seen as a lot more risky. But remember, we've spoken before about the risk-reward trade-off. Now that South African government bonds are more risky, the South African government has to offer a higher return for people who are willing to buy their bonds. That's why if you are an aggressive investor that is willing to take on a risk, South African bonds could actually be looking a lot more attractive to you right now, given that they offer higher yields. This is just a tangent, but if it has piqued your interest, I recommend that you read these 3 little articles and see what else you can find on the web about how our recent downgrade has affected our South African government bond yields. So there are 2 primary categories of capital: debt capital and equity capital, and multiple sources for each one of these types of capital. But each source has its own cost associated with it. So when we look at the capital that we'll use for a big project, we first have to calculate the weighted average cost of capital. And the fundamental principle we use to calculate the weighted average cost of capital is basically what you do to calculate your semester mark. Let's use BSS 310 as an example here. In this table are the 4 assessments that comprise your semester mark, as well as the weight for each of those assessments. Now let's imagine that your mark is there in the right-hand column. Here at the bottom, I've now calculated your semester mark as being 74.15%. The 100% accounts for 5% of your semester mark. The 67% accounts for 50% of your semester mark. 75% counts for 35% of your semester mark, and the 94% counts for 10% of your semester mark. Now let's just swap out semester assessments with capital sources. If I have a loan, which is a debt source, and 30% of my capital comes from this loan at a cost of 14%. Then I have corporate bonds that I issued, which is also a debt source. 25% of my capital comes from corporate bonds, and there my investors are expecting a return of 11%. So those are the terms that I've agreed with my creditors. I will have to repay them 14% and 11%. Then I've issued some more shares in my company, so I have diluted the ownership of my company somewhat, and I've raised 15% of the capital that I need for this project from this issuing of shares, and my shareholders expect a 9.5% return on their investment. In retained earnings, let's say 30% of my capital comes from retained earnings. Now you might ask why there's a cost associated with retained earnings if this is already money that I have. Well, where is this money? It's not in a shoebox underneath my bed. I'm leaving it, or I've left it in an account where it is earning interest, typically a money market account or some sort of very liquid investment. So if I take that money out of that account where it currently is and I invest it in a project, then I'm losing out on the return that I would have made if I just left the money in that account. Now there are many opinions about which percentage here you should assign to retained earnings. Some say you should assign the same as your shares issued because you could have paid out those retained earnings as dividends. Other people say that you should use the percentage of the account in which you're keeping it. I prefer the latter approach. So if I want to calculate my weighted average cost of capital, so the cost of all these capital sources together, I'll do exactly what I did when I calculated my semester mark. I calculate the weighted proportion that each source of capital contributes to the total cost, which ends up being 10.8%. Those are the fundamentals in calculating the overall WACC. But you can also be asked to calculate the WACC equity or the WACC debt, so the weighted average cost of capital for only your equity sources or the weighted average cost of capital for only your debt sources. Let's see what that would have been in this example. If I wanted to calculate my WACC debt, I would look only at those sources that are debt sources. Then I have to consider the proportion that the loan is of the total debt amount. So it's no longer just 30%, but it's 0.3 over 0.55. Because my total debt percentage is 30 plus 25, 55%. So this is the proportion that the loan capital is of my total debt capital, and I multiply that by its cost, which is 14%, then the proportion that the corporate bonds capital is of my total debt capital, just the yellow rows, is 0.25 over 0.55, multiplied by the cost, which is 11%. Therefore, my WACC debt is 12.64%. Now, in the rest of the slideshow, there'll be a couple of places where I'll ask you to calculate something. It'll be indicated by a question mark. These answers will be what you need to complete a future ClickUp quiz. Look out for instructions on this ClickUp quiz once lectures have resumed. Right, so now let's do the same for WACC equity. In the table, I've highlighted for you the two equity sources of capital. What you need to calculate is what those proportions would have been. The final answer should be 7.17%. If I now want to calculate my total weighted average cost of capital using WACC equity and WACC debt, I would do the following. 45% of my total capital is equity capital. Where did I get that from? Here. 15% plus 30% is 45%. So 0.45 multiplied by 7.17%, which is my WACC equity, and 0.55 multiplied by my WACC debt, 12.64%, gives me an answer of 10.8%, which is the same as the answer that we got previously. So let's go through an example. Nancy Botwin Medicinal Distillers need to finance the expansion of one of their product lines. The expansion project will require a capital investment of 17 million rand. They will raise 2 million rand through shares where shareholders receive a return on investment of 11%. Further, they will use 5 million rand of retained earnings currently in a money market account where it earns 5%. A further 7 million rand will be financed through a mortgage loan secured by new facilities. An interest rate of 11.5% applies to the mortgage. The remainder will be financed using their existing credit facility at the bank, which has an interest rate of 10.5%. The first question is, what is the WACC equity, so the weighted average cost of the equity capital? What is the weighted average cost of the debt capital? And finally, what is the weighted average cost of both capital sources together? Firstly, I want to determine all the ratios of the different capital sources. So I've gone and highlighted all the mention of the different monetary amounts in the example. This method I call the money bags approach. So I have a big money bag that has 17 million rand in it. That's all my capital together. This big money bag consists of an equity money bag and a debt money bag put together. At this stage, I don't immediately know what the size of my total equity and total debt financing is, but I can map the sources of my equity financing into my little equity money bag. So I have a shares money bag worth 2 million rand and I have a retained earnings money bag worth 5 million rand. On the debt side, I have a mortgage loan worth 7 million rand and a credit facility which has X million rand. The example didn't explicitly say, but it's pretty easy to deduce what these numbers should be. We can see that our total equity money bag is 7 million rand, which means that our total debt money bag should be 17 million minus 7 million, which is 10 million. That means my credit money bag should be 3 million. That's fantastic. Now we have all the information that we need to determine the ratios of each capital source. So if I want to calculate my WACC equity, the cost of shares will be multiplied by 2 over 7, which is the proportion of my share capital over my total equity capital, 2 over the 7. The proportion of my retained earnings would then be 5 over 7. For the debt capital, the cost of the loan will be multiplied by the proportion of the loan to my total debt capital, so 7 over 10. The cost of credit will be multiplied by 3 over 10, which is the proportion of my credit capital. If I want to calculate my overall WACC, 7 over 17, the proportion of my equity capital, so I'll multiply that proportion by the answer that I get for WACC equity, and I'll multiply 10 over 17 with the answer that I get for WACC debt. Let's go back and find the costs in the example. The 2 million rand of shares, where shareholders receive a return on investment of 11%. So that is the cost of my shares. I can go and substitute that into the equation. Next, I see that my retained earnings is currently in a money market account where it earns 5%. So if I take it out of that account to put into my project, I will lose out on that 5%. That is the cost of my retained earnings. I can substitute that in there. Next, I can calculate my WACC equity. It's 6.71%, and I can substitute that into my calculation of the overall WACC. A further 7 million will be financed through a mortgage loan secured by new facilities. An interest rate of 11.5% applies to the mortgage. So that's the cost of my mortgage. The existing credit facility charges an interest rate of 10.5%. So that would then be the cost I substitute in that last bracket. I can calculate my WACC debt and substitute that into this bottom equation to calculate an overall WACC of 9.35%. Notice here that my cost of equity capital is much lower than my cost of debt capital, but because I am blending them, in the final answer, the cost of my overall capital is somewhere in between those two. Let's look at another example. Weintraub Electronics wants to expand to a new market segment with their activewear wireless earphones. The cost of the 3 million rand they raised in equity capital is 13% per year. Their debt to equity ratio for this project is 0.4, which can also be interpreted as a ratio of debt to equity of 1 to 2.5. We'll get back to that. Half of their debt financing is from a loan at an interest rate of 11% per year, while the rest is loaned from a stakeholder at 14% per year. What is the WACC for this project? Let's start over here. Debt to equity ratio for this project is 0.4, which can also be interpreted as a debt to equity ratio of 1 to 2.5. Let's think about OROS. If you've ever made OROS according to the instructions that are on the bottle, you'll see that it is 1 part of OROS to 3 parts of water or soda water. So let me ask you this. If I make OROS according to the instructions, 1 part of OROS to 3 parts of water, how many parts of liquid do I have? 4, right? So it's pretty much the same over here. I have 2.5 parts of equity for every 1 part of debt. OROS, water. In total, I have 3.5 parts of liquid, or 3.5 parts of capital. So the weighting of my debt in this example is 1 over 3.5, the total capital. And the weighting of my equity is 2.5 over 3.5. Now a question that you can answer in the ClickUp quiz is, what does that amount to in Rand terms if you know that the cost of my equity capital is 3 million? We don't need that answer to carry on with the rest of this example because we already have the ratios. But I want you to see whether you can relate these ratios, and specifically this type of a ratio, back to a Rand amount. Let's go to our money bags. Our total capital is 3.5 parts. Our equity capital is 2.5 parts. We don't know what that equity capital consists of. On the debt side, we have 1 part of debt. Now, half of the debt is in a bank loan, which means that there's a half left, which is part of a stakeholder loan. That just basically means a loan with a specific person that has an interest in the business. But it's a loan, it's not shares. So, like you would do a loan with a bank, there are specific repayment terms. This sentence, the cost of the 3 million they raised in equity capital is 13% per year. That sentence actually gives you the WACC equity. So you don't really need to know what sources that equity capital came from. On the debt side, we know that half of the debt financing is at 11% per year and the other half is at 14% per year. So let's calculate the WACC. We have WACC equity. To calculate WACC debt, we can say 0.5 multiplied by 11% plus 0.5 multiplied by 14%, which gives me 12.5%. I can then substitute that into my WACC calculation. Here I have those ratios, the ratio of the equity financing multiplied by 13% and the ratio of the debt capital multiplied by the WACC debt, and that gives me 12.86%. Or you could have taken the shortcut. So here I calculate my WACC debt inside the square bracket, and I then multiply the answer in the square bracket with 1 over 3.5. Great, so now we know how to calculate the cost of the capital that we'll be using in our projects. But how does that influence the setting of this thing called the MARR? Well, let's go back to this analogy of projects that need to jump over a certain hurdle. What is the lowest level that you want to set that hurdle? If you're going to be investing in a project, and that project will make you money, you want to at least make enough money to pay for the capital that you've invested in the project. So the weighted average cost of capital is one of the minimum benchmarks that you have in place when you set your MARR. Let's think of another analogy, a layer cake. The height of the top of this layer cake from the table is what I call my MARR. But let's start with this ceramic dish. This ceramic dish can under no circumstances be made any lower or higher. It's a set height. That set height is what I would say is the minimum MARR. How do I calculate what this absolute minimum value is that I'm willing to set my MARR at? It's the maximum of 3 values. In the brackets here I have my WACC debt, my WACC, and opportunity cost. Let's start in the middle because that variable is the most obvious. Obviously I want to make enough money to cover the costs of the capital that I've sourced. But now I'm saying it must be the maximum of WACC debt and WACC. Why would I say that? Let's go back to one of the previous examples we've just looked at. In the Nancy Botwin example, I pointed out to you that my WACC equity is much lower than my WACC debt, and that the final weighted average cost of capital then lands somewhere in the middle. So in truth, my WACC debt is a lot higher than my WACC. So if I only make 10% return, if my proportion of debt financing is extremely high, it could happen that I've not actually made enough to cover my debt financing. Debt is a very costly source of capital because it is so risky for the person that is lending you money. Therefore, WACC debt is usually much higher than your WACC equity, and then because of the way in which we calculate our weighted average cost, WACC debt is usually also higher than your overall WACC. Because we don't always know what the proportions are, to be safe, we say that we want to take the max of WACC debt and WACC. Now, what is this opportunity cost? We've spoken about it before in class. Opportunity cost is the possible returns that I'm forfeiting because I'm not taking on a different project. Let's imagine that I have multiple different projects that I could invest in, but I don't have enough money to invest in all of them. The best project that I reject could possibly have made me, let's say for argument's sake, 10% return on investment, but I can't take on that project because of budget constraints. So that 10% is then my opportunity cost. Because I'm choosing to do the project that I'm looking at the moment, I can't invest in the project that would have made me 10%. So that 10% becomes my opportunity cost. Another way that you can think about it is that if you chose not to do this project, you could have invested the money in financial vehicles. One of the most liquid and safest vehicles being a money market account, where you would have earned, say, 5 or 6 or 7%, but you could have also invested that money in slightly more risky but slightly higher yield-bearing investments, such as equities in other companies or bonds. So if you don't have any other project that you've rejected where you could get this opportunity cost variable from, you can always look at what you would have earned if you invested that money in a unit trust or some other financial vehicle. So the maximum of these three variables is this minimum level of the MAR. Your MAR must always be at least this value. That cannot be changed. But, however, what you can change is how high you make this layer cake. A very big portion of this layer cake is a percentage that you add to the MAR to compensate for risk. Certain projects are just much more risky than other ones, and therefore if I want to embark on a very risky project, I want to compensate for that by adding percentages to the MAR. We can also add percentages for some other factors that influence the MAR. A typical factor could be the market rate. So if I am working in the construction industry and the typical MAR or hurdle rate used in the construction industry is 11%, I would be a little silly to set my MAR at 21 or 22% because those types of returns would just simply be unrealistic for the market in which I'm operating. In the same vein, if I'm working in the high-tech industry, it's a very high-risk market, so the MARs are typically high, 18, 19 or 20%. If I now go and evaluate my project at 12%, I've not taken into account the risk in the market that I'm playing in. So market benchmarking means that you look at other projects and other companies in a similar market and how they set their MAR, and you may decide to adjust your MAR up or down depending on what they've done. Remember, of course, that your MAR can never be lower than this number over here. So let's imagine a situation where you see that the market rate or the MAR that is usually used in your specific sector is much lower than this value that you have. What does that say? Basically, it says that your capital is too costly for this type of project. And let's talk about strategic alignment. Recall this little picture that I showed you right at the beginning of the video. I mentioned here that we have a strategic alignment filter, which would already exclude proposals that are completely outside of our strategy. But it may still be that some projects are more aligned with our strategy than others. Projects that are more aligned to our strategy might actually have a lower MAR at which we evaluate them. That means we're setting the hurdle a little bit lower to make it easier for the athlete or the project to jump over that. Why would we do that? What we're doing is we're trading off immediate financial goals with long-term strategic goals. So we're saying I'm willing to accept a project that cannot jump so high right now because I know that that project is running in the right direction, if you'll excuse my extension of the metaphor. So because this project puts me in a better position for future projects, I'm willing to lower that hurdle requirement just a little at the moment. The same thing can happen with management favor. So As engineers, I know this is a difficult concept to grasp, but human emotions really do play a massive role when it comes to investment and to very big company decisions. It may be that a certain project is just a greater favorite than the other projects on the table for no real concrete reason, except that those that need to make the decision really like it. In that case, they may also choose to lower the MAR just to make the numbers look better so that the project can be taken on. Tax also plays an important role in how much money you want to make off of your projects. So if the corporate tax increases, that means the proportion of your profits which you get to keep at the end of the day reduce. So you need to make more money to keep more money. In that case, you would increase the MAR. So you would increase that hurdle because projects that are financially feasible need to jump higher so that you can have more income after tax. In the case where you have limited capital, you'd also want a higher rate of return so that you can make more money in absolute terms. So let's imagine that I have 500,000 Rand to invest and I have a 5-year investment window. At the end of the 5 years, I would have wanted to make an additional 20,000 Rand. So at the end of the 5 years, I want my 500,000 Rand to have grown to 520,000 Rand, for argument's sake. That's not a very high return, but let's just use it as an argument. So my goal is making 20,000 Rand at the end of 5 years. But I only have 500,000 Rand. Now imagine I still only want to make 20,000 Rand at the end of 5 years, but I have 1,000,000 Rand to my disposal, which I can invest. The rate at which my 500,000 needs to grow is much higher than the rate at which my 1,000,000 Rand needs to grow to reach that goal of the extra 20,000 Rand at the end of 5 years. That's why when we have limited capital, we want a higher rate of return on our projects so that we can still make the same amount of money, but with a smaller base to work from. It's the same type of philosophy when you think about shorter planning horizons. If I want to make a certain amount of money, but I only have 3 years versus 5 years, then in the 3-year scenario, I would want to invest in projects that make much more money quickly. So if we go back to our layer cake, all of these factors are a part of that small little bracket at the top. Setting the MAR isn't an exact science. The one non-negotiable when we set the hurdle rate is this value at the bottom here. But how much you add to compensate for risk and how much you add to compensate for other factors very much depends on your company that you work in and the decision makers around the table. What is important is that you should know that if a project is more risky, you need to add a percentage, make the hurdle higher and not lower. And what is important is that you understand the direction in which you would change the MAR for each one of these other factors. So how will you set the MAR for your project? This is one of the things that you need to do to complete part A of your group project. Firstly, you need to determine the cost of your project, so your project budget. That's pretty simple. You've already done that in section 5. That project cost is the initial capital that you need to start off your business, right? Next, you need to determine what capital sources you'll use to fund the cost of your project, the upfront costs, and the cost of each type of capital. Please don't tell me that you'll fund the entire project with your own money, because I might just be tempted to ask you for a bank statement. The purpose of this exercise is for you to consider how you would blend different capital sources. You don't want to use all equity and you don't want to use all debt. You want to use a combination of the two. How will you find out what the cost of each type of capital is? What I would recommend is that you go do a little bit of market research on Google. Go see what type of interest rates you would get for loans at a bank, for credit card debt, for mortgages. Look up the prime interest rate, do a bit of reading to see how a bank would view you in terms of risk. Then once you've decided on your capital sources and estimated a cost for each type of capital, you calculate the WACC debt, and your opportunity costs. Now you know what the minimum MAR is for your project. Then you can consider any risk factors or other factors that would influence your MAR, and then you set the MAR. This process should be well documented, and any market research that you did to determine your capital sources and their costs should be listed in your reference list. So a quick recap. In this unit, we've differentiated between debt and equity financing. We've looked at how we would calculate the weighted average cost of our capital. We've discussed the factors that influence the setting of your MAR, and we've shortly discussed how you would set the MAR for your project.